Hey, good morning, everyone. Marty Mazzora here. It is the 9th of September, 2025, with your early/midweek update. Not a whole lot to add, or that I feel like adding to Friday's video or Saturday's video, other than to just remind you that a couple of data points this week are going to have the market's attention. Tomorrow's producer price index and Thursday's consumer price index could be market movers, as the world is intensely focused on the Fed meeting next week and what the Fed will do with interest rates. Right now, the market is pretty much guaranteeing, in terms of expectations in the futures market, a 25 basis point cut to the Fed funds rate. Anything that could get in the way of that would probably be somewhat upsetting to the market. And I want to say probably is the operative word there, because Friday was interesting, because Friday of last week we got a jobs number that really sealed the deal, save for a surprise in inflation data this week. Again, sealed the deal for the quarter point Fed funds cut, and the market rallied early. We talked about this on Saturday, and then rolled over and closed in the red on the day on Friday, suggesting that maybe bad news about the economy is not necessarily good news for markets. Also, recall the last two videos I did illustrate the on-balance volume indicator that is suggesting that perhaps the smart money, so to speak, is selling into these rallies. We did see that this morning. Early on, the S&P was higher. It dipped into the red by about 1/3%, but it's really all over the place. This market's just maybe trying to find its footing. Right now, the S&P is just barely off. Actually, it's up 2 basis points, so call it flat on the day. You can see in front of you that just 1, 2, 3, 4 of the main sectors are actually in the green, with the remaining 7 being in the red. So utilities are up a little bit, consumer discretionary stocks, communication services, and energy stocks are actually up, but 60%, call it, of the market is actually down. Clients, I usually talk to you about the core. We're underperforming today. We're down a little less than 0.25%, 0.23%. Half of that is 2 small positions, but they're down enough to account for about a 0.1% decline in our core. And both of those are in the lithium space. They've been really good positions, but man, they're giving a lot back this morning. And it's due to the announcement that a lithium mine in China that was shut down a while back is about to reopen and start operations again and bring more lithium supply into the markets, and therefore, it's suppressing the price. So these lithium stocks that really rallied hard on that, which, by the way, has nothing to do with our thesis around these two. Frankly, it has more to do about what we expect in Chilean politics over the next few months, to be honest with you, or the next month or 3, I think. And then the positioning and the low valuations, i.e. the cheapness of these stocks going in. But again, they're very volatile. Therefore, they're small, but they're volatile enough to make a difference in both directions. So right now, as dramatic as a decline is, one of them's down 12%, the other one's down 7.5%. They are amounting to about maybe 0.12% of our portfolio in terms of the decline today. The rest has to do with our broad allocation of what I just told you about sectors. Europe, which has been really phenomenal for us this year, is down 0.25% as well. Gold has been all over the place. It was actually up quite nicely this morning, and we're going to look at the gold chart again here in a minute. Then it went negative by about 0.33%. Now it's up about 0.1%. Gold is very interesting right now, as I'm going to explain some more about here in a minute. Okay, so let's just jump to some charts. I do want to talk about the valuation setup for U.S. stocks once again at the end. So the first chart I have here is a breadth chart, and I'm going to jump to the S&P 500, or I should say the S&P 500 equal weight first. So, folks, this is the S&P 500 index in its truest form, I guess. It's every position equally weighted, so you get a broad look for how the overall index is doing. It's not cap weighted like the S&P that is advertised to you every day. It's equal weighted. And as you can see, it hit an all-time high in the early December, late November of last year. And it has gone a lot of places, but in terms of where it is relative to that, it's gone nowhere, right? We had the big decline that was 20+% earlier this year, and now the S&P equal weight is not breaking out of this or above this all-time high just yet, like the S&P 500 cap-weighted index has, as you can see here, right? And so this speaks to the incredible concentration, the percentage of the move that has to do with just, say, the top 7 or the top 10 stocks is historic. And it's something to be concerned about, because when we've had this kind of concentration in the past, the late 90s come to mind, it tends not to end well. So just a red flag or a concern could be that the market broadens out and the equal weight, as I just showed you, breaks through and catches up to the S&P. That would be very healthy, and that's a distinct possibility and something we need to respect. It's just that this is indeed a red flag. The generals that have been making it all happen roll over, it gets pretty ugly in a hurry for stocks. Another look that we could call to some degree a breadth indicator or maybe an economic indicator. The top line here is the S&P 500. The green line is the Russell 2000 index, 2,000 small cap U.S. stocks. You can see it has yet to get above its levels that it saw all the way back in November of 2021. So the fact that, smaller companies employ the majority of Americans and so forth, the small cap space is indicative of the overall health of the economy. And it is where we like to go in size after a recession at the beginning of a new cycle, because they tend to outperform. They tend to underperform late cycle. Now, we do believe that we are late cycle, and having said that, we reintroduced small caps way earlier than usual because of the just unusual dynamics, and how we do have a narrative, that says that we could end up with that soft landing. But we're not betting big on it, but we are up a little bit since we added small caps. The other one is transportation stocks. Obviously, despite the fact that the economy is very changing, very technology oriented, when people buy stuff, it does need to get from one place to the other. And you can see that transportation stocks are way below their, call it 2022 high. Now, I think there is a caveat here, and that would be Amazon, right? Amazon is doing a lot of its own delivery, no doubt taking some business from your traditional transportation stocks when we're talking about specifically, the FedExes and the UPSs. But nevertheless, it's something to keep an eye on. Okay, so Friday we skipped the dollar. Don't need to spend a lot of time here. The dollar is declining on the prospects for declining yields in the U.S., if indeed that's what is about to come to pass. So that makes some sense to us here. Plus, the relative attractiveness of securities in other parts of the world has had a lot to do with this big decline that we've seen in the dollar, and it's been very much to the benefit of our core portfolio. As for yields, they are dropping like crazy. We had a big drop on Friday on that jobs number. And you can see that the 10-year yield is now down to, where we haven't seen it in at least several months now. So we'll see if that's a trend that's going to continue. Could be good for stocks, all else equal, but if indeed it denotes real weakness in the economy and therefore weakness in go-forward corporate earnings, that becomes a problem for the stock market. Gold, wow. I did not anticipate this, folks. Perhaps I should have. We can speculate as to what it's all about. Traditionally, the gold does tend to negatively correlate with the dollar, so certainly some of that in there. It responds to uncertainty. Gold doesn't pay a dividend or an interest rate, so it becomes relatively more attractive as interest rates drop. You can go on and on. A huge one is central bank buying. Central banks, we think of China and others, are buying a lot of gold these days as a reserve asset. And gold has been unappreciated. I showed you, I think it was a year or so ago, the lack of exposure to gold among hedge funds, among consumers, and so on. And it's getting a lot of love right here. And we own it below short-term treasuries. It's our biggest individual position, which again has been very, very good for us this year. But we are giving a little bit back by buying some insurance on it. We've been doing that for a while now with put options to protect our position because we're up so much, and obviously it just keeps becoming a bigger part of the portfolio. So why would we be concerned when the whole world seems to be so optimistic? Or I should say, optimism is really, really growing. One of my favorite analysts, I just read a report from him this morning. He said they're long gold and they remain bullish. Well, we remain very, very bullish longer term. Short term, being technically minded as well, you have to be cautious right here, I think. So what you have in front of you now is the spot gold price all the way back to when President Nixon unleashed gold from its $35 peg. Okay, and that was in August of 1971. So obviously and immediately gold ramped higher as it could now float freely, so to speak, in global markets. And it immediately became what we call overbought on the relative strength index. Now, here's my concern, and this is a monthly chart. This is not the daily overbought chart, which I keep showing you. So that overboughtness, if you will, was essentially alleviated by corrections of 21%, and let me move this out of the way, and 45% along the way. So from peak to trough, a 45% decline in gold. And having experienced this with gold or witnessed it over my 41 years, this is the sort of volatility that I know is potentially in the price of gold. And here back in the late 70s, we got overbought again. That right there, it looks like a small blip, was probably close to a 20% decline. And then we came out of that, got overbought over the next, probably a couple of years. The consequence was a 57% decline. Got just a little bit overbought here in the mid 80s, and we saw a 33% decline. Touched it a few times here, had some minor blips, got pretty overbought there, pretty much stayed overbought, did drop below it, about a 9%, 8.5% decline there, and then got way overbought, 26% decline in gold. Got overbought here for an extended period of time, 42% decline in gold. More recently, back here in 2020, got overbought, got resolved by a 17% decline. And folks, right now we are as overbought as we've been, more so I should say, than we've been since the 1979 scenario. Now, again, very different dynamics, real potential for structural inflation, big, enormous debt to GDP in the U.S., for example, and not just the U.S., massive, interest expense on the debt, the real need to probably suppress the yield curve like they did after World War II, which I've talked to you about umpteen times over the last couple of years. This all plays very nicely into the hands of gold. We want to continue to own it. We just want to insure it and spend a little money on options so that if we do see something like this, which we very well could in the not too distant future, I'm not promising it, I'm just saying that the charts are telling me to be cautious right here, then we can mitigate the vast majority of that decline and be in a position to do other things maybe pick up some more at a much cheaper price. So again, right now, folks, I just wanted to, because I know you're hearing a lot about gold. A client asked me the other day, should I be buying more gold? I just wanted to explain our thinking right now so that you'll appreciate why we're not backing up the truck like a lot of people are right here. As for the market, this is your monthly S&P 500 index. Again, I showed you all the way back the last 30 years. We have never been overbought without a double-digit correction. We are overbought. After being overbought, double-digit correction, overbought again. We'll see. Maybe this will be the first time in 30 years that we haven't seen that kind of correction from an overbought position in the S&P. NASDAQ, this is a daily, and this is pretty much an image of the S&P as well. Right here, virtually at or near all-time highs. Momentum kind of dying in both of our momentum indicators. It's not a sell signal till it breaks down below support here, and I would say below the 20-day moving average. If somebody wants to swing trade this thing, I'd probably buy it again at the 50 if I were swing trading. Our concern is that something bigger could be afoot to the downside if conditions evolve in a certain manner or a certain trend. And as I promised to close, I just want to show you once again JP Morgan's chart of where we are on a forward projected price to earnings ratio. So based on next year's anticipated earnings, this is actually where we were on 12/31. Right now, folks, we're actually out over here. So it's actually gotten higher, more expensive based on projected earnings for next year. So this scatter plot shows you all of the 1-year periods following all the periods when the forward PE was at the current level or the December 31 level. And as you can see here, there's all the periods where the market was down over a year, right? And here's all the periods right here where the market was up during that time period. So looks like a few more up than down. For long-term investors, here is the big concern, right? And again, this is from that 12/31. We're actually out here. These are all the 10-year periods following all the periods where the forward price to earnings ratio got this high. And as you can see, historically, there is no money to be made in the U.S. market for the next 10 years coming off of this price to earnings level. That doesn't mean that this won't be the first. It may very well be. And typically, by the way, having lived through a number of those, it's not that the market goes in a straight line. It's that it goes, it peaks in 1999 or early 2000, goes down, and then peaks again, in 2007. And so those periods are generally characterized by a steep decline off of these levels, or they're often characterized this way, and then coming back only to fail, at that previous 10-year high. And as you can see here, there have been multiple, believe it or not, 10-year periods where the U.S. market actually went nowhere. So something to respect, again, given these current valuation multiples. Now, that's not the case in the rest of the world. That's paid off so far this year, but long term, we think there's going to be lots of opportunity and some opportunity in the U.S. This is the broader market. Definitely going to be sectors we're going to want to exploit. I don't suspect it's going to be the U.S. tech sector that dominates the next 10 years, despite everything we know about AI. It's really probably going to be the beneficiaries of AI, not the AI providers themselves that actually do the heavy lifting for the market going forward, just like the aftermath of the internet bubble that blew up in the early 2000s. I'm done, folks. Thank you, as always, for watching and listening. Be back again at the end of the week. Take care. Bye-bye.